Could traders and investors be losing faith in the debt markets as both Japanese yen, German, and the US yields all spike into this inflation data coming in less than 24 hours? What exactly is going on? In today's video, we unveil what the game plan is and, of course, what we're heading into. Big earnings season and the banks are about to report. With the trend line that everybody's watching, big gamma on the way, and of course, options flows everywhere. One thing's for sure, there's a lot of huge moves on the horizon. Guys, join us as we cover stocks, commodities, and cryptos on one of the biggest days of the year. See you soon. Well, welcome back everybody to the Daily Show. My name's Tom, and in today's video, we have a lot to discuss. What's going on in the debt markets and yield? What, of course, is happening ahead of earnings season? And is leverage too high right now? Well, it looks like the bonds market is starting to flash up again, and this time we're seeing it in one of our favorite indicators coming up later on today's show. But let's kick things off here with Japan's long bonds. They are re-accelerating, and you've probably heard this by now that both the 20, the 30, and the 40-year yields are all on the rise. And this is not just happening in Japan. We're also seeing it in Germany, the 30-year at a 14-year high. The 30-year in US at 5%. We know that something has always happened at around this level. So what gives? Well, it's a mixture of either reinflation coming with, of course, inflation reports coming out in less than 24 hours, or it could be that people are starting to think about sovereign debt as a little bit risky. Effectively, there is a certain need to say, you know what? I'm not going to give you any money unless you give me a lot more in terms of interest. I think you're riskier than you were years ago. And this is starting to cause a bit of a loss of faith in the long-term fiscal discipline of the banks and, more importantly, central banks around the world, and whether we're actually going to see a bit of a crisis. And I think it's one of the most important things that you want to be watching over the next 6 and 12 months in particular, because as we know, we've got huge amounts of treasuries which need to be refinanced by the end of this year. If it's your first time here to the channel, make sure to subscribe and hit the bell for that icon as well, because this is going to be a big story. And I don't think anyone's really quite aware of how much debt really needs to be financed later on. I know you guys are, but maybe not some of the newer viewers. Let's now talk about what's happening here when it comes to June CPI. You guys know that all of these economists have different ideas. In general, they believe it's going to be 0.27. and that they think the headline is going to be 2.6%. Now, previous month didn't show that. And one of the eagle-eyed viewers out there actually posted this, which is true inflation versus BLS. And it's basically suggesting that we could be at that kind of point where maybe we should be actually seeing a weaker number, that is inflation actually dropping. And if we don't see that, he's of the opinion that maybe it's not real, because of course we have the lead indicators telling us that maybe there is actually deflation occurring, and the lagged indicator, which is often the one that we see the Fed use, as showing, possibly just kind of stagnation of these numbers. So this will be an interesting one, not to be proven yet, but of course the CPI will matter, and it's going to be one of those volatile events along with JP Morgan's big result, because of course the banks are kicking off. Usually people look at Goldman Sachs, JP Morgan the most, see what's going on. And while I would think that they're probably still going to be making a little bit of money for sure, the one thing is that the stock market has started to sell them off into this level. So we're now at the daily 20 moving average for JP Morgan. As you guys know, that is a massive support level, and it's been a very important level since we've been rallying this entire time. Where the financials generally go, the rest of the market will at least eventually follow. Let's now talk about where the flows are, though. My goodness, look at this one. Flows moving into crypto. We suspected this was happening for weeks and weeks and weeks and even months. We've seen actually a lot of ETF net flow into Ethereum and Bitcoin. And according to the latest Glassnode data, which we have over on our X account, links in the description down below, we're seeing a massive acceleration. This is actually the largest ever institutional demand here in terms of acceleration for Ethereum, and that helped to break the market out to new highs. And that's thanks to deregulation and, of course, the idea of what we've been seeing recently, which is these tokenization kind of things going on. Hyperscalers are also spending pretty big. According to the latest Goldman Sachs data, it looks like all of the big tech companies and even the smaller tech companies are going ballistic on CapEx spend. Now, we did talk about how a lot of businesses are pulling back. That's the older stocks. Things like, in the S&P 500, the older industries are spending less in the world of tariffs. But it looks like all of these big guys, and that, of course, is pretty much 37% of the S&P anyway, as 10 stocks make 37% of the S&P right now. We're basically at this point where they're spending big time on improvements in the AI world. Now, this is going to be the big growth engine for the US. Innovation is why we all love the US market, and it's been the big thing. Remember, 83% of the time, tech leads. So at the moment, we've seen semiconductors pick up, we've seen AI stocks go ballistic and hypergrowth go ballistic. So that has been really where the strength is. And you've got to always look at the US market as tech, and everything afterwards. Now, what else have we had really break out this year? Well, of course, it's been precious metals. You guys know gold, silver, platinum. I've been bullish at all, and so have a lot of you guys. And it's been, an excellent trade. I think actually platinum is the best precious metal for the year, up well over 40% since December. However, could we be starting to see other metals coming along, aluminum or aluminium as I call it, or iron ore or any of these others? Well, according to the latest data here, you can see the ratio from Octavio. Basically, this is a pretty cool read because it takes into account where gold is right now. And it says, you know what, all these other metals are too cheap. And you guys know I love ratio trades because this is how the biggest guys do it. The big investment bankers, the big hedge funds, they look at things as comparative value. And that's a really extraordinary way of doing things. When I first got into the industry a long, long time ago, and I was taught about ratioing, I was basically told this is the way that, all the big guys do it because, of course, we're looking for comparative value. And yeah, we're down at those points once again where it looks like we may be seeing a possible boost up here in metals across the board. And this actually does bring in why it's so important over the next 24 hours to see how this inflation data reads. You guys might remember the 1970s versus the current day. Are we going to get an update that actually shows that actually going up again? If that is, then we could be going to stagflation. Such an important time for investing. Speaking of which, it looks like everyone is, of course, going ballistic. We're seeing a huge amount of leverage in the system. We've got all-time highs in terms of FINRA margin. We've got all-time highs in terms of single stock leverage ETFs. And of course, we've got all-time highs in terms of markets themselves. So is that a concoction for Wall Street to eventually steal from us, the retail traders and investors? Well, you guys know it is. Of course, we all know it is. It's going to happen one day. They'll rug pull us. But if we actually look at the closest narrative, and you guys know we've been talking about this, the S&P 500 1998 versus the current 2025 market, we could be in a period here of what we call a pit, a pullback in time, or a bit of a sell-off coming into Q3. And there are a couple of reasons. One, we've never seen anything about whether tariffs actually hitting the economy or not. So that's, of course, generally lagged around 3 to 4 months, and it's been that time now. We also are due for a bit of a pullback due to the fact that everyone has been going ballistic. And of course, stocks have been going up 60 to 80% since their April lows. So we've had that epic V-shaped style rally. But imagine if this is how it continues on. Geez, there's going to be a lot of kangarooing in the markets. We're going to go ups and downs and ups and downs. And this may not look like much, but a lot of these sell-offs are in the vicinity of 10 to even 15%. Which may not sound like much, but these are actually quite large sell-offs if you've been trading the market for a long time. So that's going to be interesting. We also know that we're at that point, the middle of July. And I want to say congrats to all you guys that did buy that pit late in June and basically said, you know what, pull back in time. Statistics are that Christmas in July is one of the best reads of the year, the best 2-week period of the year, and it rallies usually into the middle of the month. Now, this is where we notoriously get the kangaroo-style market, but I tell you what a rally. Remember to keep that in the back of your mind. And as you guys know, it is pretty normal to be doing this year. Year threes, after 20% years back to back, they're choppy. They're up, they're down, they're up, they're down. They're very volatile and they're all over the place. And of course, this year seems to be following a very similar track record. In terms of forward PE ratio, we're expensive. Look at this chart here. It's not good. So we're not the most expensive we've been, but we're certainly getting up there. And the last time we saw this kind of expense was obviously when we were over here back in the October period of last year. So the markets are kind of, not cheap anymore. When they get back down to these ratios, you can kind of say, okay, it looks all right. But EPS has been on the rise, which is good. And that's telling you that, of course, okay, this earnings season may be actually all right. And possibly speaking here, we might actually be in a climate where markets could go up. In fact, this reads here, the S&P 500 technology sector is up 9.5% over the past year. Not too bad. But it's actually gotten 6.5% cheaper than it was if you look at the ratios. So this is now thanks to the 17.1% boost in forward earnings estimates, and we all know what that is. It's AI driven. So AI is really allowing the US market to recover, and it's all about that AI. All that matters really is tech right now. 37% of the S&P 10 stocks. Speaking of which, earnings season kickoff. Here are the big banks. JP Morgan will be the one to watch here. Netflix later on the week for the first big tech and interactive brokers. And in terms of expected moves, these are what the options market is kind of thinking. Some pretty large moves here coming. And you guys know that big tech is expected to move between 7 and 10%. So that's going to be huge when that does come through. I also have this kind of cool report here, which has got to do with Goldman Sachs. And basically, they've shown what they're thinking of in terms of crowded longs and crowded shorts into this earnings season. And you guys can see the big names up here: Nvidia, Meta, Microsoft, AVGO, Netflix, all with implied moves of 7, 6%, big stuff. And they're all crowded longs. So this is going to be one of those, I think, earnings seasons that's going to have some large moves in it. And be warned, if you're in these stocks, you have to expect this type of volatility. It's probably going to come through. Another thing to remind yourself of, these are the big announcements moving forward. JP Morgan report, US CPI this week. Then we've got, of course, debt ceiling increase stuff in mid-July as well, and the FOMC meeting at the end of the month. This is really, though, all about earnings season. So generally speaking, earnings season, you come in, you're usually looking at it being pretty strong, and you're generally looking as well at the overperformance of stocks. But just remember, there are sometimes time periods to sell. So what I've done is in the pinned comment down below, I posted over on LinkedIn 10 of the classic signals when it comes time to sell winning stocks. And this is from William O'Neill. It's an excellent little read. If you're interested, follow me over on LinkedIn as well. I'm posting a bunch of psychology and these types of things. So make sure to check it out, guys. Always awesome to connect with you as well. But this one, not to be missed. Definitely check it out. Pinned comment down below, completely free to have a look at. S&P 500 trend line. Okay, let's get into these charts here. We'll look at the options, then we'll look at some of the warning signs, and of course, see what was going on right now. Now, first question is, have we seen signs to sell yet? And the answer is quite simply, still no. Do we have a lower low? No. Do we have a market that's gone pretty ballistic? Absolutely. It started to really accelerate away quite a lot. And you guys can see here that if we took, well, actually not that one, but if we took like a 200, which does sit around here, you're going to be looking at pretty far away from that, and pretty far specifically away from the weekly 20, which is starting to accelerate away from. Now, this is the trend line that everybody's looking at. And a few of you guys said, oh, do you expect these gaps to be filled? Look, you always want to mark out gaps, and you always want to be aware of where they are on your charts. And of course, these are levels that you could expect markets to come back to. But the big one right now is going to be just under 6,000. That's going to be the first level where you would think that hedge funds and institutions and people that have missed out on this current rally, they're going to be pretty strong if the market does come back down there. But remember that we don't currently have a sell-off. What we do have is a consolidating market ahead of big earnings and, of course, a big report. Now, what if we do this? Boom, boom. Well, if that happens, we're looking at probably a bit of a sell. Here are the options high and low levels for the next 24 hours. If we also, now that we've made a higher high, come and sell off, then that technically could be called a double top. And of course, that should usually make A, which is the distance between the high and the low, equaling B. So basically, we'd be going down to this 6,125 area or something like that. Now, this is a very important zone. It's not just the US 500. It is synchronization of so many things across the board. The dollar being its support now, that's the US dollar. The Russell 2000 hitting supply and starting to reject it. Bitcoin, gold, silver, all breaking to the upside, Ethereum and alts. What we've been seeing recently is a bit of that rotation going on. And we've also been seeing a bit of purchasing from hedge funds into consumer staples. So what are they doing? Why are they turning a little defensive here? Maybe they know something we don't. Who knows? They've been behind for a little while. So the big thing here is, remember, follow the trend until you see signs of it cracking. And the big sign we have right now is the core wall and obviously the bonds market. The bonds market is starting to look more fragile than it was just a few weeks ago. And of course, now we have extra tariffs, we have extra things going on. So whenever the market sells, it looks like somebody is willing to put a put straight into the market. You can see that here with the latest charts, and you'll notice there are tons of puts sitting around 6250. We expected the market to be pretty flat like yesterday. It was. 6300 remains this huge strike call, but have a look here. There's this random put wall on the 15th, and it's pretty huge. Basically what we're getting here is one of those sessions where you're going to be expected to have about 6220 as being a massive, massive zone. And it's the same thing here with really what we've been saying about Nvidia and Tesla. Tesla stuck within a range, Nvidia stuck within a range. It's that 165 for Nvidia to break out from. And for the stock market, it's going to be fighting around 6220 and 6300. So these are the two big levels to break. And anything in between is just kind of go up, down, and all around, if you know what I'm saying. Now let's have a look at the bonds market. What is going on in bonds? So pretty much the bonds market is starting to show a little bit more risk. The stocks have not gone down. However, this is usually a lead indicator. So if this continues to spike up every single period and we keep doing this, then traditionally that's usually meant that a market will continue or maybe sell off. So it certainly is spiking up. This is the first time we've seen it since that last pit or pullback in time. And do remember, this helped to actually solidify the rally back in April. So certainly bonds markets and option spreads certainly starting to widen out here. And that's showing us that there is a risk in the markets. If we have a look here at the financials, you guys can see here financials just sitting and hovering at those all-time highs. And particularly JP Morgan is the one I'm watching, because JP Morgan's the only one that actually came down to that support. So the support currently is the 20. You guys can see it, series of higher highs and higher lows. We're down, we're testing that area ahead of earnings season. Another thing we want to be watching is the 30-year. We do a live stream every Monday for free. We have other live streams, of course, in our paid community in the description down below. But we know that people are watching these yields, and particularly the 30Y must be watched. 5.05%. I've got a little alert up here. If that happens, historically, we've seen either Trump or the Fed do something. And that's because there seems to be this kind of lack of confidence going on right now in debt. And that's the first time we've seen that in forever. Like, if I think back on it, the last decade, no one really has given crap about how much money's being printed, how much money's been out there. But all of a sudden, people are saying, you know what, pay up for this. We do think it's risky and we think you've pushed things too far. And this is a very interesting time for that reason. Now, does it instantly mean sell off? No. But with bonds starting to widen, with risks starting to rise up, and us getting to this trend line and core wall and all these types of things, you can see why you're building a bit of that case. And now we're just looking for some form of flow trigger. So you can see here, US 30Y, very important. Gold breaking to the upside as well. So we're seeing precious metals improve. Gold is still around that support area, 33.45. Like to see that hold and continue to move higher. And silver doing really well, hitting around 39, then breaking back down. That's to be expected. Big move up, it's going to have a bit of a move down. But what I noticed is that almost all of these breakout pairs have created that classic pin bar or shooting star style candle. A very terrifying candle if you're looking at it as a bull, because this is that classic one you get taught on when you first come into markets and it says, oh, that's a bearish signal. And look, sometimes they are bearish signals, sometimes they're not. But it is, of course, happening on Bitcoin as well, just as it came shy of 125,000. So there's certainly a little bit of money that's flowing out of those after that initial move, although I still think the general trend is up. So pullbacks, we're looking for bases now to get that next kind of pickup move. Oil, no idea what that thing's doing. It's floating up and down. You guys know I've been stagnant on that. There's no reason to really trade it. Remember, patience is the key. And you react, and you don't necessarily need to predict oil at this stage. There's just sitting around that kind of support zone after having, some massive trades on it. So what about Tesla? Well, Tesla kind of is doing this, if you get what I'm saying. So if you have a look on effectively X, there is a self-driving car, and it seems to be driving in around this kind of area when it comes to Texas. And in general, most people are kind of loving the self-driving car concept, and they're loving that idea of a hype train. December 2025. Supposedly something's coming for Tesla. So it's kind of holding the base here because of that. But that 280-300 for now is strong. 330 is the core wall at this stage, guys. Semiconductors, yeah, they've rallied up, and it certainly has come through. But one of the things that has been happening quite a lot with a lot of these markets is that they've been doing flags. So if semiconductors are to complete, you're looking at about 300. This is the sector though. So are semis still beating SPY? I'm getting overbought signals for the first time. So I'm getting basically signals saying, you know what, that's been an awesome run. Let's chill out here a little bit. It is all happening around this correlation, but ultimately it's going to come back down to earnings. Even with those, we don't have triggers for the sells at this point. What about Chinese market? That's actually going up. So the Chinese market has been improving, and it looks, really set to try to break to the upside. You can see here 3 highs, multiple tests, big rejection here. Love to see a closure high above this to probably signal a new high for the last couple of years. And yeah, I'm still bullish on China, as you guys know. US 2K struggling around supply. This is what I'm saying. There's a lot of correlation. US 2K is at supply. US 100, the NASDAQ, hitting into, as far as I'm concerned, close enough to the trend line. So I think the last 24 hours into this earnings season, we are right there on these levels. So I think some day traders, some swing traders, some positioners will be like, that's pretty sweet. I'll wait and see what happens with the earnings, and then I'll go from there. Some people are going to say, I'm an investor, I don't care. Fair enough. You're in great profit. Why would you care at this stage? And it's just all about what type of position that you're in and what you're looking for. Ethereum did break out. Now it's had that rejection, as you guys can see here. I'm still looking for 3,300, 3,400 for Ethereum. And for Bitcoin, it has that horrible shooting star on it that everyone hates. Didn't quite get to the 125, which I think a lot of people had as a target. Hit about 123, is rejected a bit. But you've got to remember where it came from. It's fine to reject a bit and then rally back up. Probably the daily 20 will be worth paying attention to. And the current price on the daily 20 is 112,000. Guys, the big news is going to be inflation and JP Morgan, Goldman Sachs. It's all happening over the next 24 hours. 8:30 a.m. inflation numbers. And then, of course, later on, we're going to get all the banks coming through. Make sure to subscribe to the channel if you're interested in that. And I guess as a brief summary, you don't really need to be terrified of anything or fear missing out or anything like that. Remember, there are always new opportunities. Some people got into Hood and other stocks, PLTR, just a few weeks or months ago, made a lot of money. Then suddenly it's Bitcoin, Ethereum, XRP, and of course things like silver. Then you can make money in those. There are always new rotations and opportunities. And I do see a few people, getting a little bit disillusioned, saying, oh, I missed this. How can I be so stupid? No one's stupid, guys. We all have our strengths and weaknesses. And in general, it's just about waiting and being patient enough for those opportunities so that you can get those fat pitches. Guys, make sure to subscribe. See you in the next one, and follow me over on LinkedIn as well if you're interested in finding out more helpful tips about trading psychology, investment, and in this case, at least William O'Neill's ideas when you should maybe sell or consider taking a little bit of profit. Catch you for now. See you guys.